In this presentation, we're going to take a look at purchase transactions. We are still in a perpetual inventory system for these purchase transactions. In the perpetual inventory system, when we buy merchandise, that's merchandise purchases, we are going to have a debit and a credit for our journal entry. So our asset account that we're going to debit would be what? What are we getting? What are we buying? Well, we're buying inventory. So merchandise inventory or inventory would be what we would debit. And how are we acquiring the inventory? What are we giving in return? That would be our credit. Well, we can either buy inventory with cash, or we can buy inventory on account with an account payable. Here we can see two transactions for purchases under the perpetual inventory system. The first item is to record a purchase of inventory with cash. I have debited merchandise inventory for $500 and I have cash $500. The second transaction is to record a purchase of inventory on credit. I am debiting merchandise inventory and crediting accounts payable, $1,500. Let's take a look at another example. S&V Corporation purchased $4,000 of merchandise on account, terms net 30. No discount here. Our first entry is to record the purchase. Merchandise inventory, $4,000 is our debit, and we are crediting accounts payable $4,000. The next item is paid invoice from purchase on account within 30 days. When we go to pay people we owe money to, that means we need to debit the liability account, accounts payable, and we're going to give them cash, so we're going to credit cash. Accounts payable, $4,000 debit, cash, $4,000 credit. We can make purchases with a discount, much like we saw with sales discounts. Massey Company purchased $2,000 of merchandise from its supplier on account, terms 314, net 45. Do you remember what these terms mean? Well, let's review really quickly. The 3 stands for 3%. The 14 is 14 days. So that we could receive a 3% discount if we pay the invoice in 14 days. Otherwise, we pay the full amount, the net, in 45 days. So we're going to journalize the purchased first. We're purchasing inventory, that's what we're getting, that's our debit, $2,000, and that's going to be on account. So we're increasing the liability, accounts payable, $2,000. We are going to pay within the discount period, and so we're going to once again take a look at our accounts payable T account. Accounts payable is a liability account with a credit balance, and we had originally made a purchase for $2,000. When we go to pay on that purchase, we would like to have that account go to zero. We do not owe that person any more money. And so we do need to debit this $2,000. We are paying in the discount period, so we are not paying cash of $2,000. Our cash is going to be $2,000 minus our discount. In this case, our discount is $60. How did we get that? Well, that was the $2,000 times 3% to give us $60 discount. So our cash becomes $1,940. Notice here, I am crediting merchandise inventory for $60. Why? Well, we are in a perpetual inventory system. When I made a purchase of inventory, I debited the account for $2,000. When I take a discount, that inventory is now costing me less. How do I account for that? Well, I am going to reduce the inventory account by $60. So now the inventory is in our records, in our account, for the amount of cash I paid for it. Now let's take a look at an example of a purchase with return on account. Glitter Company purchased $2,000 of merchandise from its supplier on account, terms 315 net 45. Now remember, 315 net 45 is that we can have a 3% discount if we pay in 15 days, or we pay the full amount in 45 days. We're going to record the purchase. That's our first step. Merchandise inventory is what we get. That's our debit, $2,000. And our credit goes to accounts payable. We're buying this on account. Glitter returned $3,000 worth of the merchandise purchased because it was damaged. Well, let's take a look at our two accounts, accounts payable, and we also have our inventory. And so we had put $2,000 in our inventory, and we had put $2,000 in accounts payable. We're returning the merchandise. That means we're no longer responsible for paying for that because we're returning it, and we no longer have it in our inventory. Here you can see I've debited the accounts payable to take the $300 off of my amount that I owe, and I have credited the inventory account to reduce that amount from our inventory since we took it out and sent it back. Recall from our previous slides we had our T accounts, accounts payable, and we had $2,000 and we took the $300 out. That gave us a balance of $1,700 that we owed. Glitter paid their merchandise purchase on account less the return, and it was paid within the discount period. Well, here you can see I have my accounts payable, and I would like to make that 0 because I'm paying. So I've made a debit to accounts payable. Cash. Well, my cash is going to be minus the discount. So $1,700 times 3% gives me $51. So my cash is $1,649. And once again, I put the discount into merchandise inventory. Why? Because the inventory is at my cost, and so I originally had $2,000. I sent back $300, and now I've reduced the cost of that. So now the inventory reflects what I paid for it.